So a quick question for you all. All right. So there's the video panel. Do I look crooked in this video panel or it looks like I'm standing straight up? So the camera itself is a little bit bent because it's been bent over. Right? I feel like I'm just angling off the side, but then I looked at it and I said, I think I'm actually standing straight up, but the camera itself is still crooked, which I'm not sure what that says about me. Anyway, not a big issue. I think we can get by without it. How was your weekend, everyone? Stay indoors a lot. Try to put it. I told my graduate students this morning I had to come to campus yesterday to try to unlock the door for some students. I showed up on campus after slipping and sliding through driving up here, got here, and I left my office keys back in my house. So, yeah, that was a mistake. But the students didn't actually show up, so it all turned out in the end. So, anyway. Happy ending ever. Real quick, I want to make a note about some of the homework stuff. So my GTRA is caught up on the homework and I reviewed the homework assignments. Generally looked really good. So there were a few issues here and there. I want to make a quick note. My general policy for homework, especially for the first exam, I know that some of the routines are a little bit hard to get down for the first time doing some of these things. If you missed points, please go in and check and see why you missed the points. And you can go ahead and resubmit, making the corrections and fix those. Again, that's usually my policy up until the first exam, especially for this course, because the multiple choice policy on this particular course is a little bit weird. But overall, it looks good. There were a few issues, but most everybody did a pretty good job. And those issues that I saw were not major or significant. The routine will get pretty standard once we get a few weeks in. All right, today we are starting our section on risk assessment, and we're going to learn about the audit risk model today, and then we're going to talk about different categories of risk next on Wednesday. And like I said, we'll have an activity in class on Wednesday, but I'll save that. I wouldn't want to spoil it because this is the fun part of this class when we get to do stuff. So let's start out with a pretty basic contention, all right? I'm going to use all of these examples that we're going to be talking about the audit classroom for obvious reasons. This is one of my few times that I will not use food for an analogy, but it's a little bit challenging. So maybe this will be memorable, the fact that I won't make you hungry afterwards. So we'll see. So my contention is that by the end of this course, that my students are going to be knowledgeable about auditing. I could make that contention under one of two circumstances, that they are in fact knowledgeable about auditing, in which case I'd be telling the truth, or that they are not capable about auditing. And sometimes I question that because I talk to students, maybe a year or a year and a half after they've taken my course, and I say, hey, quick, what are the management assertions? And they're just like, correctness. And so this is actually one student, and it's not in particular good, but I figure that everybody remembers it because I teach this every semester and sometimes multiple times a semester. So everybody should know it as well as I do, which is probably a misnomer. But yeah, at the end of the semester, I'm guessing that most people will be knowledgeable about auditing. I'm going to make that contention. Okay. Now, is it possible that I can make that contention? I can make that statement and be wrong? Yes, all right. There is a risk to that. Even if I do everything consistently the way I've done in previous semesters, it's amazing. Sometimes I'll have sections that are really good, and my students will be very, very knowledgeable and effective. And sometimes I'll have sections that are really challenging, and I have to work for it. And that is not necessarily a function of me doing anything differently. Sometimes it's a function of the environment. Like one great example, I'm going to use this a lot for different examples, had to do with the pandemic. Can you guess how teaching during the pandemic was? It sucked. All right. Yeah, it was awful. It was miserable. I'm sure learning during the pandemic was pretty bad for you guys, but teaching was miserable. In fall of 2020, we tried to set up for distance learning, and distance learning basically meant everybody had to sit 6 feet apart. Now, look around you in the room, okay? Are you 6 feet apart from the next closest person? Probably not. The classroom of this size was actually set up in the 3rd floor of the library, and in the classroom. And that was the most miserable thing because half of the students couldn't hear what I'm saying. And I'm a boisterous individual, right? But I'm having to try to, I had to use a microphone in some occasions just because it was really, really rough. And then they couldn't see the screen. They couldn't get an eye of it. And trying to get discussions in that kind of environment was impossible. Like the activity that we're going to do on Wednesday, we couldn't do because everybody was so far apart.
So there may be reasons why that's the case. In any case, I'm going to make a contention, and it's possible that I could be wrong about that contention. Now, from an audit perspective, this is contextually equivalent to something called audit risk. Now, we already know about audit risk as one of our three concepts that we've already talked about, what we talked about in the first lecture. By definition, audit risk is the risk that an auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. Probably more specifically, when we talk about audit risk, we're saying the auditor expresses a clean audit opinion, an audit opinion that says everything is fine, when in fact everything is not fine. So again, I think I mentioned this when we talked about this in the first lecture, but we talked about this idea of type 1 error and type 2 error from science, okay? Type 1 error says there's a problem when in fact there's not a problem. Generally speaking, we as auditors are not concerned about type 1 error. We're very concerned about this, which is a type 2 error, saying that there's no problem when in fact there's a problem. Now think about this from a scientific perspective. If you go to the hospital and you're feeling really, really bad, and you go to the emergency room and you sit down and they say, says, I feel bad, and the doctor checks you, says, yeah, you're fine. And in fact, you've got a very, very bad disease that's going to leave you debilitated for the next few months. Would you be a little bit upset if your doctor said you're fine and in fact you were really, really ill? Probably so. And that's kind of the same idea behind audit risk, is that we don't want to say things are fine when things are in fact not fine. How big a problem is that? Okay, let's see if this works, okay? Unqualified opinion plus materially misstated financial statements. Come on, do it. No, it's not going to do it. It's not going to do it. I have a GIF that's embedded in this set of slides, and when it works, the world explodes, okay? But it's a hit or miss as to whether it works. It's like a 50% chance, and we got the downside of 50. So even though I tried, even though I put the GIF in here, it didn't work. That's audit risk for you right there. That's audit risk, okay? So we're going to talk more about the nature of assertions next week. And there's going to be a lot of them, and they're going to be really, really important. But at a very basic level, assertions are expressed or implied representations made by management regarding the recognition, measurement, presentation, and disclosure of information in the financial statements. Now, this will become important for obvious reasons here in just a second, but I do want to explain the nature of assertions and how this is measured. So this is the same thing that we've already talked about. When the financial statements contain an account balance of $30 million for inventory, managements are representing the inventory exists and is properly valued. And those are two explicit assertions: existence, occurrence, and valuation, allocation, accuracy. So management's saying, look, by putting this in the financial statements, I'm telling you, you can find this inventory somewhere in our warehouses, maybe multiple warehouses, and the cost basis for this inventory is accurate. We can actually prove that. So we as auditors should be able to test this and find that. But this is a really important concept, because this is what drives all of auditing, are these assertions. We're saying management is making an assertion, much like the assertion that I made earlier, okay? The assertion that you all are going to be knowledgeable about auditing when everything comes back, all right? So there's risk associated with this idea of assertions. When we talk about the nature of audit risk, we consider audit risk at the assertion level. Now, what does that mean, and how do we break it down? At the assertion level, we're saying we evaluate audit risk in the context of these assertions. And there's two ways we can think about audit risk at the assertion level. The first of all is the risk that relevant assertions related to the financial statements contain the statements that could be material to the financial statements. So there are material errors in the financial statements, all right? And this is going to emanate from something called inherent risk and control risk. We'll talk about more of those in just a second. The second risk is going to consist of the work the auditor does. There's a risk that the auditor will not detect these misstatements. That's our job. We're trying to make sure the financial statements are free from material misstatements. If we fail to do so, that's categorized as detection risk. Now, detection risk is really confusing, but we'll get to that here shortly. All right, so let's go ahead and talk a little bit more about these individual components of the first part: inherent risk and control risk. All right, so is there a reason that it might be difficult for you all to learn auditing? It's a very scary word, first of all. You've never heard audit in a good context, unless you said, auditing class is so much fun. Dr. Martin is such a great instructor. If you've heard that, cool, all right? But you probably never think IRS audit and think, wow, that sounds like a great thing. It just sounds awful, all right? So auditing class is going to be subject to certain risks that make it difficult to understand. What are some of those risks, okay? First thing we're going to talk about, something I alluded to at the very beginning of the semester, There is a lot of information in this class, a lot of detail. We're not going to even cover probably 50% of it. You're still going to feel like a lot of information. Secondly, it's constantly changing. Something that's accounting is subject to. Every accounting form except for cost accounting. Cost accounting stays the same year after year after year. Tell Dr. Ochero I said that too. All right. Cost accounting stays the same, but every other accounting form changes from year after year. All right. And then also, I hate to say this, but auditing can be boring. Okay. It can be a little bit boring and tedious. There was a former professor here that I love to make fun of, and I'm so sad he's gone because none of my jokes about him make any sense anymore. His name is Alan Davis. He was a tax professor back with Dr. Caden and Dr. Fouch, and he was a character. He was a curmudgeon, all right? And he used to tease me and say, yeah, auditing is a boring class. And I said, yeah, it really is boring. It takes an exceptional instructor to teach it well. And so that's my key is that auditing can be boring. It takes a good instructor to make it interesting. So yeah, those are all risks that are related to this particular course. And by the way that I characterize this is we're talking about this idea of inherent risk, all right? Now, inherent risk has got this long, drawn-out definition. The susceptibility of assertion of encounter disclosure to a misstatement or due to error, fraud, that can be material, either individually or when aggregated with other misstatements before consideration of any related controls. That is a lot to consider. So in other words, I want you to think about it this way. The fundamental risks related to an entity's operations. Inherent risk is this concept that when you go into business, you're subjecting yourself to certain risks. So if you go into a business that requires inventory, does inventory availability present itself as a certain risk? The cost of inventory, the availability of inventory, all of those things. Those are things that the moment you start your business, you're subjecting yourself to. We as auditors need to be aware of those risks. We need to be aware of the risks that are present in business. So I've got a few examples of these. You don't need to write these down. They're fairly intuitive. But what are some inherent risks that could be present in auditing? Well, high volume of transactions. Many businesses, especially the really large ones that we're talking about, have a lot of transactions that occur on a regular, if not daily basis, okay? Complex taxes and calculations. As you start learning more about accounting, you start realizing that estimates become prevalent or even allocations, some things that are not necessarily intuitively sensible. Use of estimates, we just talked about that. Risk of technological obsolescence. Yeah, technological obsolescence is one of those things I love to talk about. We'll talk about it more in this course, but technology is constantly changing and evolving, which means old technology is bad. Actually, one of the Vita G chairs came to my office last week and he was just giggling. He was so excited. He showed me a diskette. Has anybody ever seen a floppy disk? Yeah. He was like saying, well, how do you even use this anyway? And I said, you make me feel so old. All right. But yeah, they had apparently in the Vita office, there was an old diskette in there, a 3.5 diskette. And I said, yeah, you want to go really way back. Look at some of the 5.25 diskettes, and those are some things. By the way, that save symbol on Windows, that's actually a diskette. That's what that thing means. Okay, if you didn't know that before, what the save symbol is, like that's what's really weird, guy. It's a floppy disk. Okay, so that's what that means now. All right, I'm getting off track. Working capital concerns. We talked about debt covenants and how you have to maintain liquidity. They don't have proper working capital. That could be a concern. And increased business risks. Business risks are, again, evolving and changing. One thing that's particularly profound and pronounced in this current environment that we're operating in has this thing called cybersecurity. Has anybody heard that term before? If you operate in a technological capacity, you are subject to cybersecurity risks just by the nature of being in an online available business. So a lot to consider there, and we have to be responsible for all of it as auditors. So we have to know what risks that we're going to be present to. However, we're not the ones that are solely responsible for addressing those risks. In fact, I'd say we're just checking to make sure that our client is responding properly to those risks, because clients have to respond to risks appropriately. We know this because we learned this in Accounting 367. Remember that other class you took with me? Okay, AIS. What was my favorite thing to talk about in that class? Controls. What is the definition of a control? You're on the right track, okay? At a more basic level, the way that I describe it is a response to a risk. Okay, we identify a risk, and then we appropriately respond to it. All right. Now, we know controls are great because Dr. Barnes told you so. All right, we know controls are great. What we have to concern ourselves with is that controls may or may not work in a proper capacity. Okay, controls should theoretically address the risks appropriately that we identified in this part. But what if a control does not respond properly? What if control is not correct? So let's say, for example, going back to this class, what is my control for making sure that you all learn material in this course? I've got, as I say, I've got 4 of them scheduled in this course. The exams. Okay, so that's my control. All right. What if they are, and to a lesser degree, we could say the assignments is going to be another one of those. Okay. Okay. What if I fail to give assignments or exams in this course? Everybody would be like, yes. Okay. But would that reinforce learning of this course, the materials in this course? I hate to admit it. Everybody wants to say, Dr. Barnes, I would learn the material just for love of it. And then you'd look at me with honest eyes and say that, and I would have to call you a liar, okay? Because I've done that before. I tried to teach courses without exams or without homework, and it did not work, okay? It did not work. That's a lesson learned. But so that's my failure to control if I didn't put that control in. Yes.
You didn't do test your homework. How did he know that it worked? Like, was it just like a final at the end of the year that you did for no points? Or like,
well, there were still points and there were still assignments in the class, but basically it was all integrated in class. But because there was no exams and there was no actual mechanism for reinforcing the content learned, half the class was really engaged and was looking at me and very, very engaged in the content. Half the class, like, what am I doing after class today? Like completely, totally tone deaf and was like saying, I don't need to. He says it's relevant and after this class period. So yeah.
There were controls, but not efficient controls.
Yeah, there were some controls, but they weren't very good controls, and I did not reinforce them well. It was very early on in my teaching career, so I learned that lesson the hard way. I had this idea that I wanted to be like Socrates, and I just wanted people to learn for the sake of learning. Okay, I am not Socrates, guys. Okay, I am not Socrates. All right, another possibility. Okay, I could give exams, I could give assignments. Is it possible that I could give exams and assignments that don't cover the material or that not relate to the material that are supposed to be being covered? So, like saying, how were the audit exams? So stupid. He kept talking about the management assertions, and then we get an exam and it talked about cheeseburgers. Yeah. So yeah, I could give you assignments and exams that are not relevant to the things that you need to learn. So that's kind of the idea, this concept of control risk. Okay. So the risk of misstatement could occur. An assertion about a counter-disclosure that could be material either individually with aggregate other misstatements will not be prevented or detected and corrected on a timely basis by the entity's internal control. Now, that definition, other than the prevented or detected and corrected, is really kind of, rambling. I will want to talk about this, but we can save this discussion for later. In other words, risks that are still present after an entity takes action to address its inherent risks. Okay. So any risks that still exist after the entity implements its controls are going to be categorized as control risks. Now, this generally falls into one of 2 categories that we need to be concerned with, okay? The first category is going to be controls have not been properly implemented. Now, this could just be an absence of controls, which is obviously gaping hole, but could be a control, like Ozzy implied, that was implemented, but it's not a good one, okay? It's not properly implemented, does not address the issue that's being addressed. This is something we call a deficiency in design, a deficiency in the design of the controls. The control itself is there, it just doesn't address what it needs to address. The deficiency in design. The other possibility is that an implemented control is not effective. An implemented control is not effective. So the control as designed is good, but people don't follow it. Does everybody remember the picture of the car that I put back in AIS? Okay, I had all of my slides and I said, this is really important. This means something, okay? And a picture of a car, it says CAR, Custody Authorization Recording. What was that called? Segregation of duties. You thought you got away from that. That's going to be in this course too, okay? Segregation of duties. I told you that 3 responsibilities have to be separated out in a business process in order to have effective controls in that area, okay? What happens if the 3 people who are working that area say, you know what, I don't feel like working today, you just do my job for me, okay? Does that defeat the purpose of the control? Yeah, the control is present, but it's not being followed, okay? It's being ignored. We call that a deficiency in operation. So deficiency in design. The control is there, but it's not doing what it's supposed to be doing. Deficiency in operation, the control does exactly what it's supposed to do, but people don't follow it. Those are kind of the two breakaway points that we're concerned about with that particular concept. We're going to deal a lot more with that in chapter 6 and 7, but for right now, you need to know the distinction between two types of control risk. Now let's talk a little bit more about these two categories of controls, okay? Two categories of risk, okay? So level of inherent risk are a function of the entities and the environment. What does that mean from an audit perspective? It means the auditor has no or little to no control over these risks. So as we're going to talk about here, we're going to actually set levels for these different levels of risk, and they're going to be kind of qualitative measures. But we need to think about these as the fact that we assess this. We do not influence this, okay? If I say inherent risk is high, that is because the entity has made inherent risk high. Nothing I can do as the auditor can make inherent risk lower. I can't change that function. That's basically something that's a function of the entity and its environment. Also, auditing standards refer to the combination of inherent risk and control risk as something called the risk of material misstatement. That was that first component. The combination of these two lead to something called the risk of material misstatement. All right, let's go ahead and talk about the third part of this particular model, okay? So going back to audit class, my boss, Dr. Caden, has anybody interacted with Dr. Caden? She's the most wonderful human being, but I say nasty things about her. It's just awful, you know? I say terrible things, mostly because she's a tax professor, okay? And they're just my sworn enemy. But Dr. Caden is evaluating my performance at the end of the semester, said, did you do your job properly? And I'm gonna say, of course, Dr. Caden, I always do my job properly, okay? And then she checks and sees that I'm a slacker, okay, which is pretty much true, okay? All right. So there's a possibility that I could not be doing my job, but there's a possibility that she could not figure that out. She needs to evaluate. She says she sees my student evaluations and evaluates, okay, the students are doing pretty well. She sees my grade distribution. She gets the knowledge of seeing the placement and then talks to the employers and say, yeah, these people appear to know their auditing concepts really well. Very, very sound on a fundamental conceptual level. She does a lot of review work. The interesting part is I'm making her an auditor in this example, okay? She's auditing my work, okay? She hates that. She hates that when I say stuff like that. Anyway, there's a possibility that she could not be thorough enough to do that, okay? She sees the evaluations, and it turns out I bribed all my students to give out evaluations, okay? You know, how do I bribe? With cheeseburgers, because that's obvious. That's who I am, okay? But there's a possibility that she could be deluded or deceived by the evidence that I provide to try to show that I'm doing my job. This is something called detection risk. This is the risk that the procedures performed by the auditor to reduce audit risk to an acceptable level will not detect a misstatement that exists or could be material either individually when aggregated with other misstatements. In other words, any risk remaining after the planned audit procedures. So we assess risk and material misstatement. We're going to determine what we think we need to do in response to that. If we fail to do a thorough enough job as auditors, then we may not detect a material misstatement. And that is where problems occur. That's where the issues are happening. So the auditor is kind of the last line of defense. And if there's a material misstatement, we need to make sure that we detect that problem. If we don't do our job thoroughly, material misstatement could happen. Okay. Now, note here, it says detection risk is determined by the effectiveness of audit procedures and how well the procedures are applied by the auditor. So how do we know what level we need to assign for detection risk? And the answer is good question. Let's get to that here in just a second. But I want to throw in one more concept before we move on. This is something that's in the book that is very relevant, but is kind of external to the audit risk model. The audit risk model is 4 components: audit risk, inherent risk, control risk, detection risk. But there's something called engagement risk that we need to address because it is related to the audit risk model, but not really specifically to any one of these components. So engagement risk is the risk the auditor is exposed to financial loss or damage to his professional reputation from litigation, adverse publicity, or other events arising in connection with audited financial statements. Easy example of this. When I say the word Anderson, what do people think? They think one of two things. Not good, Dr. Barnes. So they say, what's Anderson? Both of those are valid answers. Both of those are valid responses. Anderson was the auditor for Enron, okay? They did not do a very thorough job, and their reputation suffered as a result. There's another more practical example, okay? So engagement risk cannot be directly controlled by the auditor, though some control can be exercised through careful acceptance and continuance of clients. So going back to what we talked about last week, we can control engagement risk by only taking on clients that we think are going to be appropriate and we can do a thorough job. So what's an example of this? Now, this is a little bit of a graphic example, and I apologize in advance, but this is one that I think will easily jump to mind, okay? A few years ago, Grant Thornton decided to stop auditing a company called MindGeek, okay? You have probably not heard of this company, but you probably have heard of one of their business lines that they operate. Now, I'm not going to name this particular business line. I'm just going to say it is a hub for adult content on the internet. All right. Now, does everybody can everybody kind of connect the dots of where I'm getting there? Basically, Grant Thornton said, we did not want to be associated with this particular business model as this represents engagement risk associated with our business. It doesn't really matter whether or not they're doing a good job in their financial statements. The nature of their business presents certain litigation and problematic concerns for us as auditors. So they basically said, we are not going to be auditors for this particular company anymore because we do not approve of this business model. That's a stark example of engagement risk and an auditor's response to it. Okay. Again, I apologize for that particular example, but I think it is a very compelling example to explain that particular concept. Getting back to something called the audit risk model. All right. So audit risk model can be expressed as a mathematical equation. Now, it's important to note this is a conceptual example, not a practical one. You can assign numeric values. They have to be percentages to get these relationships to work, but it's more realistic to assign qualitative levels. And we'll get to that here in just a second. So the model expresses the general relationship of audit risk to the auditor's assessment of risk and material misstatements, which is inherent risk and control risk, and the risks that audit procedures will fail to detect a material misstatement and irrelevant assertion, which is called detection risk. So let's go ahead and talk about each of these individually, because I think this relationship is important to understand, but we're trying to ultimately determine is what we think detection risk should be. Now, just looking at the way this relationship works, we can kind of say the detection risk is a function of audit risk divided by risk and material misstatements. Would everybody say mathematically that makes sense? Moreover, we can say that audit risk and detection risks are going to be directly related because audit risk is the numerator. I probably should have done a better job with the fractions, but I'm really lazy, guys. So anyway, audit risk and detection risk are directly related. Now, make a note of this. This is a correct characterization of the relationship, but audit risk is generally a constant. Audit risk is generally a constant. We are usually going to set audit risk as low or something even lower, okay, very low. Regardless, it does not change to a functional amount. We're not going to see a lot of variety in audit risk. Therefore, the relationship between detection risk and audit risk is really not relevant because it's always going to be at a low level, lower, which can be kind of redundant. So we're more concerned about this relationship between detection risk and risk and material misstatement. So risk and material misstatement is high. What does that tell you about detection risk? If they're inversely related, it's going to be low. If risk and material misstatement is low, detection risk is going to be high. All right. We're going to talk about the implications of that. But I do want to talk about something that's really important to understand. Now, for the most part, this is a really, really confusing concept. But for the most part, when we talk about risk and material misstatement, risk and material misstatement is usually characterized by which is lower, okay? Inherent risk or control risk. Whichever has the lower level will usually dictate what we think is going to happen with risk and material misstatement. Now, this doesn't make any sense because if you think about it from a mathematical perspective, you're going to say, well, what if inherent risk is low and control risk is high? Shouldn't that be moderate? You say mathematically, that's correct. But conceptually, let's go ahead and take a look here. I'm very proud of this, by the way. I made this image myself. All right. So it's called Club RMM. This is the newest club in Kirksville. All right. I don't know if you've ever been there on a Friday night, but tunes are spun by DJ Double I, Dr. Ison's side gig, one of his many side gigs. Yeah. So we've got two bouncers, or two doormen, I should say. Okay. We got Irving, IRVING. Let me see what I did there. Okay. Yeah. And then Craig, CRAIG. Irving lets people in the waiting area. Craig lets people in the club. Now, let's say that they're meeting in the same number of people every hour. Okay. 5 people every hour. Okay. So Irving lets 5 people in the waiting area. Craig lets 5 people in the club. How many people are getting into the club every hour? 5. Okay. Because it takes 5 to the door. Okay. What happens if Irving suddenly gets really upset with the people outside and says, I'm only letting 1 person in this hour. All right. But Craig says, I'm letting in 100 people in this hour. How many people are getting in the club? 1, because Irving's basically assuming there's no other people in the waiting area, only 1, because only 1 person got to the waiting area in the first place. Okay. What about Craig saying, I'm only going to let one person in, but Irving sits 100 people in the waiting area. How many people are reaching the club? Still just one. Does everybody understand why the lowest level dictates that? Okay. Now, conceptually speaking, how does this relate to what we're talking about? Let's say, going back, let's say I have a company with really high inherent risk. They are subject to tons and tons of risks, but they have done a phenomenal job of implementing controls. They have implemented these incredible controls that address every problem that they could probably face. So inherent risk is high, control risk is low. What does that mean about risk and material misstatements? It's going to be low, okay, because the controls address all the possible risks. What if the company has zero controls in place, but they're such a weird company that they have zero inherent risk, okay? So inherent risk is low, but control risk is high. What does that mean about risk and material misstatement? Still low. Does everybody understand this concept of risk material misstatement being dictated by the lowest level of whichever two? It's controversial, but that's the way that I kind of characterize this. And so I wanted to kind of clarify when I say that, what that means. All right, let's go ahead and figure out what's going on with this. So again, subjectivity involves the judgment of auto risk components. Many accounting firms find it more appropriate to use qualitative terms rather than percentages in this model. So let's go ahead and use some qualitative terms to characterize this. What we've got here is a question from the, I think it's the book. I don't remember which question it is. So we're going to look at audit risk and risk of material misstatement and set detection risk based on these levels. So again, the easy way to think about this is that audit risk does not really matter in the assessment of detection risk. What we're concerned about is risk and material misstatement. So if I say audit risk is low and risk and material misstatement is moderate, what does that mean for detection risk? So high, moderate, or low, what do you think? So again, low is not going to be relevant because this is not going to dictate it. It's not going to be relevant to the relationship. Only thing that we care about is moderate. And what's inversely proportionate to moderate? Moderate, yeah, it's moderate. So right in the middle stays right in the middle, okay? What if I say auto risk is very low, but risk and material misstatement is high? What does that mean for detection risk? Low, okay, detection risk is low. What if auto risk is low and risk and material misstatement is low? What is that going to be for detection risk? High, good. See where we're going. The auto risk is very low. Risk and material misstatement is moderate. Still just going to be moderate, okay? That's all there is to it, okay? Pay attention to what the level is here, and the opposite of that is what we set for detection risk, okay? So you imagine kind of a sliding scale where one moves up, the other moves down, okay? Now here's where things get really confusing, all right? Here's where things get really confusing. We need to talk about detection risk and what the implication is. And the reason I'm going to focus on this so much is because, first of all, I've had students that have gotten confused by this in the past. Not many, okay? Truman students are really sharp, but I have had a few. Secondly, when I took auditing, my professor did not do a very good job of explaining this. I was completely baffled by it. I didn't actually learn this until I got to graduate school. I was just like, oh, that makes a lot more sense, okay? So why do we say the detection risk is going to be high or low? And this is really important to understand. If you don't catch this part, this is going to baffle you for the rest of the semester. When we characterize detection risk, we are characterizing in terms of an auditor's tolerance for risk. We're characterizing in terms of an auditor's tolerance for risk. Now think about this. If I say just risk is high, you probably say that's a bad thing, Dr. Barnes. Or if I say risk is low, you say that's a good thing, Dr. Barnes. What if I say my tolerance for risk is high? Is that a good thing or a bad thing? That's a good thing, okay? I've got high tolerance for risk, okay? It means that I can be subject to a lot of problems and still be okay. What if I say my tolerance for risk is low? That's a bad thing. So you need to think about detection risk as this concept of what can an auditor tolerate? It's not risk in the traditional sense, it's more of a tolerance for risk. Now, the reason this is relevant is because we've already established that risk and material misstatement is inversely proportional to detection risk. So if I say detection risk is high, that's saying risk and material misstatement is low. Now, intuitively, if you hear risk and material misstatement being low, do you think that's a good thing or a bad thing? As an auditor, I think that's a great thing. Whenever there's a risk and material misstatement, if there's a low chance of that, means there's a low chance the financial statements are materially misstated, okay? If I see detection risk is low, that means risk and material misstatement is high. When you say risk and material misstatement is high, what does that mean? It means there's a high chance that there's a misstatement in the financials. So in the first situation, we have a high detection risk, or more importantly, we have a high tolerance for misstatement, okay? The second situation, we have a low tolerance for misstatement. I would rather have a high tolerance for misstatements than a low tolerance for misstatements. That's kind of my goal there. So detection risk is going to be inversely related also to the strength, detail, and quantity, or the nature, extent, and timing of evidence the auditor needs to collect. So if I have a high tolerance for risk, that means I have less work that I have to do as an auditor, because I don't need to worry too much about a misstatement occurring. Again, keep in mind here that this is naturally accompanied by risk of material misstatement being low. So if risk of material misstatement is low, that means there's a low chance the financial statements being misstated. I don't have to do as much work as an auditor. I'm confident that the financial statements have a low chance of material misstatement, so I can draw back the level of work I perform. So risk of material misstatement is low, detection risk is high, nature, extent, and timing of my testing is low. On the other hand, if risk of material misstatement is high, if you hear that as an auditor, you cry a little bit inside. Okay, that means that you're going to be working a lot of hours during busy season. That means my tolerance for risk, my detection risk, my tolerance for risk is low. I can only tolerate a little bit of risk, not a whole lot of it. So my nature, extent, and timing of test is high. I have to do a lot of work to make sure that I catch all possible mistakes. Does everybody understand when we say detection risk is kind of counter to the way we run it. It's a tolerance for risk. And detection risk dictates how much work that we have to do at the end of the audit. How much work we have to do at the end of the audit. So if I say detection risk is high, you need to get in the natural state of mind of thinking detection risk is high. That means nature, extent, and timing is low. I like less work. That's a good thing. If I say detection risk is low, that means nature, extent, and timing is high. You're going to say, I'm like Dr. Barnes. I'm really, really lazy. I don't want to do work. Being a lazy accountant is a good thing, by the way. That's something I learned at a very early age. A lazy accountant will find more efficient ways to do things. Or they'll do it wrong, one of the two. But they're okay. No. Obviously, doing less work is kind of what we're angling for. We want to have less work, less things that we have to do because we've already got plenty of work already. Kind of a side note to this, to properly assess the risk of material misstatement engagement risk, the auditor needs to understand management objectives and business strategies related to business risks that may result in material misstatement. Now, business risk is a pretty basic term. It's something you've already been subject to in other courses. It basically is kind of a broad concept, but they do have the effect or the potential to affect financial statements either immediately or in the long run. So something we're going to talk about, we're going to talk specifically about the risks within the audit risk model, but we're also going to be talking about business risks at a very basic level. When we look at clients and say, what business risks are the client subject to, and how do those have the propensity to impact the financial statements or the financial statement audit specifically? Those are going to be questions that we need to answer over the course of the semester. Okay. So something I want to introduce you to. This is going to be a little bit of a spoiler for what we're going to be talking about next week, but I do think it's important because we're going to reflect back on this. Remember we talked about audit testing, we talked about evidence back in chapter 1, and I said there was a big long list that you don't need to worry about right now. We're going to get to the point now that we need to start talking about this. When we're talking about planning, we generally do not gain any assurance during the planning phase until we get to risk assessment. Now, remember, assurance is this idea that we're gathering information about the nature of the client. The more assurance we have, the better and more informed an opinion we can render as auditors. When we get to risk assessment, this is the first point that we actually gain assurance. We actually start doing testing and gaining assurance, okay? So this is going to be considered our first step. Now, it's important to note that generally speaking, the way that I think about this is that we have not gotten to the point that we're thinking about assertions yet, except from an audit risk perspective. We won't really do assertions testing until we get to test of controls and then substantive testing. But we can get assurance overall at the audit at this point. That means that we can perform some testing at a very basic level. So what types of testing can we perform? And this is going to be our introduction to evidence, audit evidence that we're gathering. Now, I mentioned that there's 10 types of evidence. Today, we're going to talk about 4 of these, and these are very, very basic and preliminary. Now, the first of these should be fairly straightforward. This is called inspection of records and documents related to the business operations of the client. All you really need to know about this is accounting records generated by the client that relate to their financial statements and the financial statement audit. And it makes the most sense because this is going to be our kind of our default as any kind of accountant, whether it be auditor or accountant or just financial accountant in general. If we want information about the operations of the financial statements, we would like to look at the accounting documents that generated those financial statements. So accounting records and documents, inspection records, especially records and documents is something we're going to do as auditors to look at those. The next we're going to do is observation of personnel and processes. So if you want to understand how things work within an organization, just watch the people who are responsible for doing them. Third, we're going to talk about inquiry of people within and outside the entity. So you want to understand the operations, talk to the people who are responsible for those operations. The fourth of these is going to be a little bit more subtle. We're not going to understand this until we get to next week on Wednesday. This is called preliminary analytical procedures. Right now, all I want you to do is remember that. First of all, I want you to remember the word preliminary, but I also want you to remember analytical procedures fit in here. We'll talk about what that means here when we get to Friday. Or not Friday, next Wednesday. But this is an important step in the risk assessment procedures. Now, a few notes about this, okay? A few notes about this. First of all, and probably the most important note, is you need to remember these three types of evidence. You need to remember all of these, but I want you to pay a particular emphasis of these three up here. And the reason why is these are our three most versatile types of evidence as an auditor. We can use these three types of evidence in every phase of testing. And we're going to talk about three phases of testing. We're going to talk about risk assessment, test of controls, and substantive procedures. And next week, I'm going to ask you a very particular question. I'm going to say, what phases can this be used? The good news is if you get inspection of records, documents, observation, inquiry, because some people are going to be assigned to those tests, and I ask you that question, you get to say all three. You're going to remember back to this discussion where I said this particular item can be used in all three phases of the audit. It's those three. More importantly, if I ask you for the future, if I say, okay, we're in test of controls, give me three types of evidence that can be used during test of controls. You're going to say inspection of records, documents, observation, and inquiry, without thinking, because those three can be used in every phase of testing. Also important to note about these particular items is that you may think that these are not very specific tests. These are very general tests, and you're correct, okay? This is testing when we do not have a lot of information about the client. This is very broad levels of testing because we're not looking at specific transactions. We're not looking at specific financial statement accounts. We're looking at very, very broad detail associated with the organization. So these types of evidence are intended to be broad. They don't get really, really down to detail. We're going to have a lot more tests that will get into a lot more detailed focus. All right, last thing to talk about. Well, kind of the last thing to talk about. So as far as the risk assessment goes, the auditor should obtain information on these risk assessment processes and verify whether it's operating effectively. Okay, so keep in mind that thing that we called the COSO framework. I know that you probably have tried to get that out of your mind, and I don't blame you. Okay, that's fair. But we had that step called risk assessment. And what was the whole goal of risk assessment? The idea is that we have to be able to assess risk, or our client has to be able to assess risk properly in order to create controls. So if they do not have a proper risk assessment, then they are probably not responding to threats in their environment and thus probably not updating their controls properly. So if the entity's response to identified risk is adequate, if their control is adequate, we can reduce the risk of material in the statement, which makes sense, okay? If the control is good, control risk probably goes down. What happens when control risk goes down? Risk of material misstatement likely goes down as well. What if the entity's response to the identified risk is inadequate? Well, the auditor's assessment of risk of material misstatement may increase, okay? We believe that control risk should be moderate. We look at it and the controls are terrible. So the control risk goes up to high. That's going to increase our risk of material misstatement in all likelihood. If the entity does not respond adequately to business risk, the auditor will have to develop tests to determine if any misstatements are present in the related account balances or disclosures. Basically, what this means is that if we cannot gain assurance from controls, we are going to have to find assurance later on. So our hope, our dream in most scenarios is going to be as auditors that clients have very, very good controls and that we can rely on those controls to some degree to get some assurance. Because if those controls are good, it reduces the work that we have to do. All right. Think about it this way. If I do a good job of giving you assignments and exams that reflect the knowledge in this course, that's going to teach you about auditing. And you'll learn about auditing, and you can go out in the real world and you can actually leverage that knowledge to some degree. If I do a poor job of that, then when you go out in the real world and your boss actually says, I need you to perform this particular task. You know, I don't remember this from auditing. I don't remember Dr. Martin's ever talking about this. I'm going to have to learn how to do this on my own. The controls in this class prevent you from having to do additional work later on, which is kind of the goal of this course. And that's the goal of a financial statement audit, is to identify what areas we can rely on the controls within the entity and what areas we need to do additional work to gain our assurance. Now, this particular model, the auto risk model, is going to be something that's relevant, but we haven't got down into the individual components. We've not really talked about what control risk represents and how that relates to test of controls. We won't get into that until chapter 6. Suffice to say that it'll be pretty important, okay? But right now, what I need you to remember is that this is kind of a linear process. We assess auto risk, we assess inherent risk, we assess control risk. Those determinations give us detection risk, which kind of gives us the scope of the work we have to do at the end of the audit. Now, how do we assess the risk of material misstatements? The answer to that is to be continued, okay? Because we still got the last part of chapter 4 to talk about. Suffice to say, that is going to be covered on Wednesday. So we are done for today. Ta-ta for now.